Hello and welcome to another episode of the Golden Thumb Rule, where we decode timeless investing insights through simple, powerful rules that help you make better decisions every day. Well, I'm your host, Kshitij, and today we are diving into a conversation that every investor, beginner, or a seasoned professional grapples with, and that is growth versus value. So how do you strike the perfect balance, and more importantly, how do you do it consistently across cycles? Well, to help us unpack all of this, we have someone who has spent over 2 decades, or could say 25 years, understanding cycles, companies, and rules that actually creates wealth. We have Anand Shah with us, who is a CIO, PMS, and AIF investments at ICICI Prudential AMC. Anand, welcome to the Golden Thumb Rule.
Hi, thank you, Kshitij, for having me. And yeah, it's a pleasure to be here.
Absolutely. Pleasure to have you, Anand, on the show. And let's start with the first and very basic question. And that is, what's the thumb rule for choosing companies over chasing markets?
Look, the whole trick is the power of compounding. What can you do consistently, sustainably over a long period of time is what will create wealth. And chasing markets, yeah, you will get it right, you will get it wrong. At a scale, you can't do it. And that's where very clearly we have this mantra called companies create wealth, not markets, right?
Yes.
And by that, what I mean is that while markets will have its cycles and markets will go through ups and downs, what one step further we'll have to go is we need to identify businesses which can actually survive the difficult times and thrive in the good times. And to that extent, we are looking for businesses, we're looking for companies which have very strong business models, which can then thrive over a one cycle all, which is a bear bull market, a slowdown, or a growing economy. They do extremely well in that entire cycle.
Absolutely. And in fact, when we're talking about market cycles, let me also, add the other question to this one. And what's your thumb rule for separating market noise from business reality? Because nowadays, what is happening is there's so much of information, not just, in newspaper, but a lot of it is floating in the social media, and which creates a lot of noise, which was not there probably, a decade back, you could say that.
Indeed, and I think those are the opportunities rather than challenges for us. Because what happens is noise, you call it momentum,
Sure.
They don't last long. So they are more 6 months to 2 years phenomena. Whereas when we look at businesses, we look at companies, we identify them, we're looking at what is going to happen in the 4th year, in the 5th year, in the 10th year. And that's where by ethos or by the various even definition, the way we look at businesses, noise would remain irrelevant for us, and that's how it becomes actually an opportunity rather than a challenge.
Also, let me take this chance and ask you: can you give us a thumb rule that sort of guided you the most consistently over the past 25 years of journey?
No, I think very clearly we said India is a growth economy. And it's been the growth economy forever and will be the last large economy which will remain a growth economy, right? All along in last 25 years, we always looked for businesses which can grow faster than the sector, and sectors grow faster than nominal GDP growth rate. But obviously the caveat being that they need to survive the downturn. So I think superior and sustainable earnings growth. These are the two key words we have sort of always chased, if I were to use that word, that we want a superior earnings growth rate, but that should be also sustainable. So both the aspects, the growth with the risk incorporated in it, that is what has been the driving force for us, or at least for me, for last 25 years that we have been, and that's worked beautifully in these markets for last 2.5 years.
Let's also discuss about the BMV sequence as well, Anand. If you could sort of throw some light on that particular aspect as well.
Yeah, so this is something which is an iterative investment thesis that we have built, but basically it's a formula to identify superior and sustainable earnings. So the BMV, in that BMV, B stands for business, M stands for management, and V stands for valuation. So there are three elements to the B. One is growth, which I briefly touched upon, that we're looking for businesses which can grow faster than the sector, within the sector, which can grow faster than the GDP. Second, for the sustainable part of it, we are looking for moat. We call it sustainable competitive advantage. So every business that we've been owning, we're looking for that one or two. At times it is more than two, but one or two elements which makes that company stand out. It has a certain sustainable competitive advantage which allows it to survive the downturn and thrive in the good times. And the third element which we sort of introduced, rather I introduced it much later in my career, was sector consolidation versus fragmentation. So when you identify good businesses with strong moat, what accelerates the wealth creation is typically the consolidation in that sector. So for a very long period, if you see, there is a consistent wealth creation in businesses which consolidation either through earnings growth rate is superior, or there's multiple expansion or a growth multiple expansion in those sectors which are consolidation. And similarly, we have seen fairly good examples of businesses where there has been a wealth destruction. The competition gets in. When you're making too much money, you're attracting new competition. Right. That is a period where either there is a degrowth in EPS, the way it would have happened in telecom business in 2006 when a lot of players entered, or more recently in the paints business when few players came in. I think that's a third element in the B, which is preference for the businesses which are consolidating versus businesses which are thriving. But once you like the business is only when we go to management.
Sure.
So business comes first. In management, we're looking for two aspects. One is the competence of the management, which have a lot of quantitative elements like market share, margins versus the industry, return on equity, and so forth, but also corporate governance. Once you like business and management, then it's much more simpler that once you have identified good business and management, then are we paying at a right price? In the sense, if you pay too much for a good business and management, it might do well, but you might not create well. So then you also need to be cognizant of what is the price you are paying for that good business and reasonably good management. And that's in a nutshell, is the ethos of BMV philosophy.
Let's also come to the heart of the conversation, which is, the growth and the value that we talked about. So what's your golden thumb rule for balancing growth and value in any market cycle?
My take is that all the three elements, which is the growth and the quality and the valuation, all three needs to be there in that stock for you to really make good money. So a growth stock at a wrong valuation or a value stock without a growth, both will not be like that. If you get the business wrong or a management wrong, in a nutshell, if you get a growth wrong, you end up paying a lot more. Or you get a quality of business wrong, you can end up losing a lot more. When you get the valuations wrong, and given that we are very conscious of what price we are ready to pay, you end up losing in the short term 10-20%, maybe 30%, but you're not permanently going to lose money if you're in the right business. So our order of looking at a stock in a B and an M is basically telling you that our preference is first for the growth and quality, and then what price we are ready to pay for that. Sure. To that extent, the first filter or first elimination happens when you're not a growth company or you're not a quality company. Then you're anyways eliminated, notwithstanding what price you're trading at.
Absolutely. And my other question is also very, you could say very crucial one, and I'm sure you must have come across a lot of times as to how can one avoid a classic value trap?
Value without quality, which in a way you can call it a return on equity, is a measure of a quality of business. So a value without a return on equity or a value without a growth might not make sense. To that extent, ability of business which is reasonably priced or today is in a deep value, if it can generate cash flows and reinvest that for the growth, I think it's a perfect value business to own. But if you're looking at a business which has no growth elements or doesn't have a competent management to capture any of the growth opportunities in a country like India where there are growth opportunities everywhere, that would be a classical value.
Absolutely. And in fact, my last question is a very interesting one. And so for investors who don't have the privilege to go and meet the company management, so what's your thumb rule for spotting management quality before meeting the management?
Go through 10 years of annual reports. I think that's the best starting point for anybody who doesn't have access to management. Because the commentaries in those annual reports, the data you can crunch in terms of cash flows converted from profits, what sort of incremental ROEs you have generated. There are many data points which will tell you the behavior of the board, the behavior of the management in the past, and tell you a lot about the quality of management and the corporate governance of the management, apart from competence. I think that's very important. On top of it, obviously, specialization in a sector. If you are sort of investing into a particular business, you need to know a lot more about not only that business but entire ecosystem in that business, which will then allow you to cross-check, and if an element of a certain sector is growing rapidly, our ecosystem is also benefiting from that or not. You will come to know whether growth projections are right or not. So, I think those are the standard, things which we do much before we actually end up meeting and managing.
Well, on that note, Anand, this has been incredibly insightful conversations full of simple, enduring thumb rules that investors can apply right away. Well, thank you so much for taking the time out, Anand. It's been a pleasure having you.
Thank you so much for having me.